Hello, my name is Weston, Head of Research at IG. As traders, we want opportunity, we want flexibility to be able to make money in any market condition, and of course that's where CFDs can really give us that edge. They give us the opportunity to be able to make money in rising markets by being long, and also falling markets by being short, and that's something I touch on in greater depth in the Art of Short Selling video. But if we can combine the two, we can really increase that chance of being strategic in markets and put us much on a level playing field with things like hedge funds and other asset managers as well. And that's where pairs trading can really come in. Pairs trading or long-short strategy gives us that opportunity to make money in any market condition, be it very volatile markets or low volatile markets or sideways choppy trading markets. The ability to pairs trade gives us that opportunity within markets, which is great. Pairs trading by its most simplest nature is just looking at the outperformance of one market or one instrument relative to another. If I believe BHP is going to outperform Rio, for example, I'll go long or buy BHP and I'll short sell Rio. It's very, very important to make sure that my dollar value of equity or my nominal exposure is exactly the same on both trading legs, otherwise I have a bias in one direction or the other. So that's something that needs to be very much in the forefront of trading and behind the mechanics that's involved. Trade like a hedge fund. Hedge funds have been doing this for years, some successfully, some less so. Most of the time they will tend to trade within a very correlated sector. For example, West Farmers Wharves is a very traditional pairs trade scenario, or the banks. They may look at valuations within CBA relative to Westpac, for example, or the miners. They may feel that BHP has upside because it has greater exposure towards petroleum than Rio, for example. But either way, generally people will look at pairs trades within a very correlated market or within a sector. But that's not the way it has to be. There are other manners of pairs trading going into markets as well. We can look at outperformance of an index. So if we think the ASX is going to outperform the FTSE, for example, we'll be long the ASX and short the FTSE, making sure our dollar value is the same. We can do it on commodities. If I think gold's going to outperform silver, or if I even can go into different asset classes and look at ways of equities outperforming fixed income and vice versa. So there are many different ways of trying to make money in these financial markets, and that gives us that opportunity that we're looking for there. Now, in terms of the mechanics are actually pretty simple when you get the hang of the math that's involved behind the scenes. If we look at an example where we believe the CBA is going to increase in value relative to that of Westpac, and we use an example where we use a shared exposure or a shared equity value of $5,000 on both legs of the position, effectively I can buy, and let's bear in mind that CBA at the time was trading $78 and Westpac at 31, I can buy 64 shares of CBA and have an exposure of 161 shares of Westpac, which I sell short because I believe that CBA is going to go up on a relative basis to Westpac. Now I will pay margin or place margin on both legs of the trade of $250. There's a 5% margin rate on the banks, so we know that we take that margin rate off the total exposure. So we're placing margin of $250 on both legs of the trade. So now I've got a position of 64 shares long of CBA and I've short sold 161 shares of Westpac. Now hypothetically CBA goes up to $90, which is a rise of just over 15%. Westpac at the same time has also gone up, but by a less aggressive 12.9%. So this is what our pairs trade is trying to achieve. We want CBA to go up much more aggressively than Westpac. Now our nominal exposure at the start was $5,000. We had an equity exposure of $5,000 on both legs. The new exposure on CBA has gone up to $5,760. So we're making $760 on this leg, but we're losing $635 on the Westpac leg because we are short. So if you net the two off, we're making effectively on the pairs trade $125. Obviously we need to minus any commissions and interest charges of holding the position overnight, but effectively our pairs trade is working really well. CBA is going up more aggressively than what we're seeing in Westpac. In this example, CBA again, same price and same characteristics of the trade, we see a situation where CBA has actually fallen 10.2% to $70, and Westpac at the same time has fallen $25 to $25, which is a more aggressive fall of 19.4%. So while both positions have fallen, we've seen a situation where CBA has fallen less aggressively, which of course is great for our pairs trade. If you look at the new nominal exposure on the position, we can see 4,000. We're actually losing $520 on the CBA leg, but we're making a much more amount on the short leg of Westpac. And if you net the two off together, we're effectively making $455 less of any commissions and interest charges there. So even though both legs have fallen, we've seen a situation where CBA has fallen less aggressively, which is great for our pairs trade. Now, the benefits of pairs trading really for me is it takes a lot of the market sentiment out of the game. You see a situation sometimes where central banks will come out and talk about economic or monetary policy, and you'll see a situation where rising tides lifts all ships, and that macroeconomic sentiment reverberates around all economic asset classes. Pairs trading removes a lot of that. It makes us much more market neutral. So that's a great situation. If you just want to look at markets in their purest and looking at pure outperformance of one stock or one instrument relative to another, pairs trading and long-short strategy removes a lot of that macroeconomic sentiment, which really frustrates a lot of people in markets. And I think it's a really pure way of trading and really getting aggressive with markets going into that situation. It gives us that flexibility and robustness there as well. Now, in terms of different strategies, one that I really look for is momentum. I like to be long stocks which are exuding the strongest underlying sentiment, and I like to be the weakest stocks as well. I wouldn't like to short stocks which are the weakest and have the most structural issues as well. We can do that on a valuation perspective as well. A lot of people will look at the banks and they will look at stocks where there's a valuation discrepancy and look to be short the one which is perceived to have the most value relative to being short stocks which have a more expensive valuation as well. There could be structural issues with the companies. There could be macroeconomic thematics such as will we see interest rates being cut, and therefore which are the best stocks which are most likely to benefit, and obviously being long that one relative to one which could obviously be negatively impacted by lower interest rates and a falling Australian dollar as well. So there's a lot of ways we can look at pairs trading, but certainly most people in the market will start off by looking at stocks which are very, very correlated in markets there as well. So there are a lot of ways we can make money in markets. I think pairs trading is one that people should look at as an opportunity to really get aggressive with markets and give us that opportunity we're looking for.